Hello, everybody, and welcome to the accounting class. This is going to be chapter 1, which is going to be the introduction to accounting. So, we're going to go ahead and get started. So, when we're introducing to accounting, here are the topics that you will be seeing. So we will be teaching the basic principles of accounting. So, collecting, recording, as well as journalizing, and we will be utilizing a general journal. We will be going over the accounting equation. We will be understanding the rules and the laws of the generally accepted accounting principles. We will also look into the merchandising operations of a business, so understanding how sales and revenues work, as well as how to make purchases for inventory and how to collect those sales and profits. We will also be creating financial statements, and lastly, we will touch upon a little bit of payroll, which is essential for business, especially when you want to have employees. Okay? So, first thing that we're going to go over is going to be business organizations. So here we want to understand, well, first off, what is the nature of a business? So the nature of a business is to use the basic resources such as materials and labor to produce a good or to provide service to customers. All right? The main goal of all businesses is to maximize their profits. They want to make money. We also want, for the customer side, is also to maximize savings for our customers. So, being in a business where we are selling goods and services, we want to also provide the quality as well as producing a good service, a good and service. Okay. Now, the types of business organizations that we will be looking into, there are a total of 5. Our first one that we will be looking into will be a sole proprietor, partnerships, corporations, limited liability companies, and lastly, non-profit organizations. Okay. So, what is a sole proprietor? A sole proprietor, will consist of only one person. Okay, so this person not only owns the business, but they are the business. Okay, so we want to make sure that we understand that whatever the owner is, the business is the same entity. Okay, so that means this person is going to be the sole person that does all the activities that involve into the business. Okay, he owns all the assets, all the liabilities, and the equity. Okay, so a little fun fact here is there is a rule on for the IRS saying that if you are a sole proprietor and if you do not make profits within 3 out of the 5 years, you will be considered not a business, but a hobby instead. So this is where you will get taxed heavily because you're not running a business. You are functioning as a hobby, something that you do on your own time. So again, this does fall in line with the nature of a business. You want to try to maximize and make a profit. Okay? So here we're going to talk about the advantages as well as disadvantages of being a sole proprietor. So number 1 is the easiest and the least expensive form of business to start. Like I say, for example, all you really need to do is you need to go to the state agency as well as the local agency and all you're going to be doing is you're going to be submitting a business license application and paying the fee to apply for the license. And after maybe a couple days or weeks or whatever, it gets approved. Boom, you become a business. So it is very easy to start a business. Okay. Next thing is that as an owner, you have full control of making all the decisions and how your business is run. So you get to make all those decisions, whether it's choosing to invest in something or maybe to go with this company instead of that company to create your products or whatnot. So again, the owner has full control to make decisions for all its business activities. Okay. Another thing that the owner can do is the owner can either keep the money so he can pocket the money when he gets a profit, or he can take that profit and reinvest it into the company itself. So, when you reinvest into a company, you're basically putting money back in, maybe to either expand or to continue the business without taking money away from it. All right. Fourth is going to be personal tax deductions, because you are the sole proprietor and the business is one. You get to write off personal taxes for your business. Okay. And then lastly, it is very easy to dissolve. If you become bankrupt, you just need to sell all your assets and give it back to the bank, and you're good to go. So again, the benefits of being a sole proprietor is it's easy to start up, and it's also easy to dissolve. It's easy to just get rid of your company. Okay. Now, what are the disadvantages for being a sole proprietor? Is that one thing is that means if you and the business are one, that means all of your personal assets are at risk. So if you owe money to the government or to the bank or something, they can and you don't pay or you fail to pay, they can come after your personal assets. So when you're dealing with a sole proprietor, you may have to put some things that are under as collateral. And what happens is if you fall on a payment or you don't pay, the first thing that they can do is they can come after your personal home, your personal car. They can go after any personal asset that you own. All right. Second thing is all businesses and personal assets are at risk. So I just talked about that. So number one and number two is going to be going hand in hand. Now, the third thing is you're only limited to your personal savings and consumer loans. So again, if you're a small startup company, you're only going to be allowed to utilize the money that you originally invested into the company. So applying for a business loan can be it can be approved, but there are some circumstances where if you're just a fresh company and you're starting up, they may not approve you right away because you're not guaranteed to provide profits for them. So there's no way that the bank is going to give you money to invest if there's no promise of a return. Okay, so you're only limited to what you put into the company. And then other things is when you have employees, it doesn't really attract them because if you're a startup company, one thing that employees look forward into when going into working for a job is they look at the benefits. And if you're a small company and you're starting out, you wouldn't be able to afford any of those benefits for your employees. So that's why it's not something that many employees would look into working for a company for you, because you can't provide them any benefits. And then yes, so and then if you do have employees, those deductions or those tax write-offs that you can take for your employees, not all of them can be written off. So because you're just such a small company, you might not be able to write those deductions off for those for your business. Okay. All right. And then, so now we're going to be moving on to partnerships. Now, there are two types of partnerships, there's a general partnership and a limited liability partnership. Now, the first type of partnership is it's going to require at least two or more people. And what happens is when you're dealing with a general partnership, you are splitting the profits and ownership either in half, so 50-50, or depending on the ratio. So you will be needing to have a business plan to be written out on how much ownership you own the company. Now, most companies either go 50-50 or 40-60. If you do have 3 people, sometimes it's broken down to 30-30-40. All right. So again, all the partners are responsible for running the business, but they are also responsible for any liabilities. All the partners are equally liable, or based on their percentage, they are liable for the company. Okay, so again, same thing with splitting profits. Now, the difference between a general partnership and a limited liability partnership is that you can have two or more partners. However, you need to establish one of those partners to be the general partner. This is for those who've heard this before, the term of a silent partner. So what the general partner does is they're fully responsible of running the business, making sure that all the business activities are being going through, making sure that all the proper functions of what a business does for it to properly run. The silent partner typically is a person that usually just invests their money. So normal way of agreements or profit sharing would be based upon how much they originally invest in the company. So this is where the moral lines would be 40-40-20, or you may even see limited liability partners are usually 20%. It could also be if it's just 2 people, mostly it'd be split 30-70. It just depends on how much they invest into the company. All right. And then, yes. And so for those that are only investing into the company, they do have limited liability. So whoever is the general partner, they are going to be mostly liable for anything that happens to that company. Now we'll go ahead and talk about advantages and disadvantages of being in a partnership. Now, the first advantage of being in a partnership is it is easy to establish. However, it does take time because you need to create a business plan. But not only that, you need to also outline all of the agreements that are involved creating the business, like laying down how much profit each partner gets, how much ownership of the each partner gets. Also, like what kind of duties does or responsibilities does each partner play into the company. So again, that is very, very key when going into a partnership. All right. Number 2 is the ability to raise funds. Now, of course, if you are in this partnership, okay, you're able to also be able to find some local investors or even partners that want to invest into your company. So it's easy to raise money. Number 3 is tax deductions for profits. So yes, you guys get a lucky tax deduction for the profits. And fourth, lastly, hiring employees is good because you have the potential of being you have the potential of becoming a partner or a part of the business based on just you working there. So it's very attractive for employees because they have the possibility to become a partner if they wanted it. Okay. Now so of course the disadvantages of being in a partnership is, first things first. The when you're making decisions based on the partners, right? If for any reason you guys come into a disagreement, or if one partner decides to do something without the other partner knowing, so that means the first thing is you are responsible for every action that your partner does. So if you guys are talking about something and you guys disagree, and one partner decides to just go ahead and move forth with his idea, you are responsible for if his idea faults or something is wrong with him. You are also, you have to, you are responsible for his actions. Okay. Second thing is, obviously profits are shared. You're not going to ever claim the profits all 100%. So again, it is going to be shared. Third thing is you're going to have disagreements. Every partner has a disagreement. Okay? There will be disagreements. Fourth is some employees' benefits are non-deductible to the business. So, for example, this means if you do have employees, not everything you can deduct can be deductible. In a sense of if you're paying for your employees, there are some things that you can deduct and some things you can't. And then lastly, it has a limited lifespan because if one partner leaves, that's it, the partnership's over. Okay. Now, what you can do is if a partner does leave, so most common things that you will see is a limited liability partnership will occur if, let's say, you started out with a general partner, you have two partners that are there. What you can do is if you want to continue being a partnership, you may have to have someone new in, or you would find someone to just help you invest and you'd be the primary general partner. Most common one you would see would be a limited liability because, nowadays you can't really trust anybody. So, if your partner does leave for any reason, you don't want to just put some random stranger unless, they have a lineage to you. It's your, some kind of relationship, right? So what you can do is a second option is you would just refile to your local government agency, and either you reestablish your status as a sole proprietor, or you would just find a partner that is willing to invest in your company and just continue as a limited liability partner. All right. Now we're going to be moving on to corporations. So there are 4 characteristics of what a corporation is. Okay. First off is there are shareholders. Okay. There are no owners. It's going to be shareholders, as in there's more than one person that owns the company, and it's going to be based on how much stocks they own. Okay, so again, when you're moving into when we're looking into companies that are corporations, shareholders are not responsible for any action or any lawsuits that come the corporation's way. The entity itself is completely separate from its shareholders, so they have limited liability. All right. Number 2 is they form some kind of central management. So of course, what shareholders do is they elect what's called the board of directors. So they are the ones that make decisions for the corporations. All right. Third, they have the easiness of transferability of shares. So what that means is, so when you're corporations, when you own shares or stocks of a certain company, when they make profits, what they do is they make the board of directors make a decision whether to disperse dividends, which is to split up the profits and give it to every single person. Now, most common things that you will see is that they will not pay, and that they will just take that money and reinvest it into the company. So either expanding, opening a new location, as long as you own a part of the business, and the money that you're making, if it keeps going back into the business, then the business has the money to expand and so on and so forth. And then lastly is continuity of life. So again, because the corporation and the shareholders are two separate entities, the corporation will remain alive in a business as long as there is at least one shareholder left. Okay? So, again, if there's only one person left, the company will still continue, and so on and so forth. All right? So, advantages of being in a corporation is going to be that shareholders have limited liability, so that's a good bonus. Like if you own a portion of the company, if they do get into a lawsuit, again, you are not responsible, but the company is. All right. Second is that shareholders are only held accountable for their investment. So depending on how much stocks they own is going to determine how much input, as well as how much they are liable for. Third is going to be raising additional funds. So most corporations, they are easy to have money flowing into the company, because all they have to do is have stocks on sale. So that's their form of how most companies invest into, or have money to invest in, is by just releasing stocks and having people purchase them. All right. Again, tax deductions for having employees. So of course you get to take a huge tax deductions for having employees. And then lastly, they can elect to be taxed as an S corporation. So again, I'll go ahead and talk about the difference between an S corp and a C corp. Now, if you want to be taxed at a C corporation level, you're going to get taxed twice. One for personal income, and second as a corporate entity. All right. Now, the flexibility as well as the option to be able to be taxed at the S corporation level is that you get to be taxed only once, and it's going to be based on personal income. All right. Then lastly, disadvantages of being in a corporation is that you require a lot of time and to establish a corporation. So you can't just start off a business as a corporation. You have to climb the ladder. And when you're doing this, you got to start off as a small business. And once you start off a small business, when you start growing and having more customers, more vendors, becoming a successful company, opening a lot of stores and whatnot. Once you become big enough and you're generating a lot of income, that's when you generally is when you can decide if you want to incorporate or not, and to become a corporation. So again, it's not the easiest. It takes a long time to become a corporation. All right. Second of all, because you have shareholders, right? So because you have more than one person owning the company, therefore nobody owns the company. So therefore, the only person that's actually governing this entity is going to be the federal or state or even local agencies, okay? So remember, they are going to be the one that's going to be moderating to see if these corporations are following the regular rules and guides to for being a corporation, right? And then third, they do get higher taxed and can get taxed twice. So again, if you're filing as a C Corp, you will get taxed twice. All right. Next is going to be a limited liability company. So what a limited liability company is, it's going to be a hybrid between a corporation and a partnership. Okay, so it is not a corporation, but it's a legal company entity. So again, what it is, it could be either 2 or 3 people running the company, but how they're being, how they are characterized is they take some traits that are like a corporation. So again, for a limited liability company, they only have the option to be able to choose 2 characteristics of a corporation. So again, looking at the 4 characteristics, so they can decide if they have shareholders. They can decide if they want to have a central management, or if they want to decide to have at least one person continue the company, can do that. Now, advantages of being a limited liability company is that when we're dealing with tax, again, you have the choice to either be taxed at a corporate level, okay, which is always a good thing because you never want to have to owe more money to the government. Second thing is, it is limited liability, just like in its name, it's limited liability. So whatever, however many owners you have, if the company gets sued, you are not liable for it at all. The company is. All right. And you can collect, you can elect one member to be the entity. So you can have someone be the president, or most companies do CEOs of a limited liability company. Another thing is there is no annual shareholders meeting. This is very important, especially when you're dealing with multiple people or multiple owners of a company, is that you don't need to have these meetings, and you don't need to make executive decisions, right? You can, again, going back to part 3, is that you can elect someone to just run the business for you. Number 5 is so again, number 5 is going to be less administrative work and record keeping. So again, what the limited liability company does is, like, instead of having all these people having extra people to run the company. It's limited. You don't need to do as much work when you're doing a limited liability company. And then lastly, you can elect memberships to happen. So what this is based off, it is like kind of like appointing certain officers. You can have members of the community to do certain things. You can assign them. Okay. Now the disadvantages of having a limited liability company is, you have to have at least 2 people in order to run a limited liability company. You can't have one because you need to at least, the rule is you need to have at least 2 to run or 2 members. Okay. Second is you can have a limited lifespan. So again, if a partner does leave, it can shorten the lifespan of the company. Most limited liability companies are considered as self-employed agencies, or self-employed entities, so they can get taxed for that reason if you're a limited liability company. All right, and then if the profits of the limited liability company exceeds over 50%, it can be taxed by the federal government. Yes. Fifth is retirement benefits. So if you are a member of the limited liability company, you cannot take advantage of stock options. So what that is while you're a membership of the company, you can purchase stocks, which allows you to be a part of the company. So again, this is part of retirement. Is when you're retired and you leave the company, you actually cannot own a part of the company. So yeah, that's definitely a disadvantage. Again, some states may tax LLCs, so not only are you going to get taxed at the federal level, you're going to get taxed at the state level, and you're going to get taxed as a federal level. And then number 7 is, if you do, for some reason, are converting an existing business into a limited liability company, you can get taxed for it. I know that every time you apply for a business license and you're changing the status of the business, you are and will have to pay a fee to receive that paper. So again, this kind of applies to all. Lastly, that we're going to be looking at is going to be a nonprofit organizations. So this one, right? It's pretty straightforward. These organizations are not designed to make income, but what their sole purpose is to either provide education to the public, public awareness, public services, anything that's cultural related, anything that's professional, maybe even religious purposes. So their main purpose is just to spread awareness about a certain belief. All right. So again, here are some actual common ones. So we do have PETA, not us PETA, but PETA for the animals. So we have them. We have the breast cancer awareness. They're definitely nonprofit. St. Jude, Comic Relief. So all of these organizations, they want to spread awareness. So again, that's their main driven goal. So the one thing that they're characterized as is they have definitely no owners. No one owns a nonprofit. What it consists of is members, all right? and these members, they're purely voluntary. So no one's forcing them, or they're not getting paid. Some organizations do pay their members, or the president at least, for working, for organizing, but also running the nonprofit organization. So yeah. Now, how do nonprofits make money? Well, it's easy. They're primarily funded by their own members. So you need to apply for a membership to become part of this organization. Again, how they can also get money is they can either do fundraisers, they could do they can have people donate or contribute money to them. Again, they can also get federal or state grants. So, or like, most case, actors or actresses or anyone that's famous will donate a huge portion of money to a certain organization to help them be able to do their functions. So again, they are non-for-profit. Their goal is not to make money. Their goal is just to spread awareness. So with that comes with special taxation rules, because they're not making money for a profit. Okay, so they have special taxation rules. All right, and we're going to be moving on to business activities. Right? So business activities. Okay, so what we're going to talk about when we talk about business activities is what is their primary core of what's their primary activity, or what is their primary core of operations. So again, we have 3 types of business activities. We have service companies, which they provide services. So auto mechanic, right? They provide services. They don't sell items to a customer. They primarily do service. So again, other examples are lawyers, accountants, any cable companies, right? They provide services to their customers. Second one, which we primarily are focused on in this class because we're dealing with sales and how to purchase inventory. So our main focus is going to be merchandising company. So what is it? It's a typical retail store, okay? So anything that sells goods to its customers, right? So example is going to be grocery stores, clothing stores, anything that sells a product. Again, there's also wholesalers, which sells goods to either in large quantities, either to the public or to other retails. Okay. And the last type of business activity we're going to be looking at is going to be manufacturing companies. Now, they're the ones that's going to be building they're the ones that are going to be building the products to sell to retail stores, or what they can do is they can also sell it to the individual customer. Typical example would be any car manufacturing company, so any car dealership, right? They build the automobile from raw materials. They assemble the whole thing, and then they either sell the product to the individual, or they have a car dealership with all the types of cars there, right? They sell it to the public, right? Now we're going to go into accounting. What is accounting? Okay, so accounting is going to be a systematic process of analyzing, recording, summarizing, reporting, reviewing, and interpreting financial information. So again, it's just collecting them, and it's the main goal of what accounting is to answer these 4 questions. It's going to answer the question of what kind of transaction is this? when did this transaction happen? Why does this transaction happen? And how did this transaction happen? All right. So again, financial information is used to measure the economic activity of a business. So again, what these this accounting, what it does is meant for when we're creating financial statements. The main focus is to provide these financial informations to its internal users and to its external users. All right. So internal users is anyone that's in the company. So what this accounting can do for this company, right? If you have a profit manager, what they can do is they can interpret the information and then they can project or make predictions on how the company can make the decisions they need to either increase profits and so maximize profits and minimize costs. So again, these information is very crucial for internal users. Now, how it's useful for external users is if you are looking into a bank loan, if you can provide all this financial information proving that your company is doing well, it's making profits, your books are clean, it's good to go. So what an external users is anyone outside the company, and what they can do is with the information, they can interpret it and make it an executive decision whether to invest into your company or not. So again, financial information is very important to all users. Then we're going to be looking into primarily what is the difference between a bookkeeper and the accountant. So financial accounting is going to be focusing on the basics of collecting and recording all daily business transactions. So the key difference between the bookkeeper and the accountant is the bookkeeper, all it's responsible for is to just record the business transactions. That's it. What the accountant does is it records the business transactions, but they also analyze the information. They can make conclusions or any opinions on those transactions. They are also the ones that are responsible for creating the financial statements. So again, and they can interpret the information there. So the bottom line is all the bookkeeper does is just record the transactions. The accountant records and it analyzes the data. Okay. Now we're going to be looking at the 5 areas of accounting. So again, this is very important that you understand the difference between these 5. Again, our main focus is going to be in the private sector. All we're going to be doing is we're going to be looking at small businesses. So we're going to go over every single detail between those 5 areas of accounting. So the first area of accounting is public accounting sector. So again, this is where CPAs belong, all right? So certified public accountants, all right? This is where, this is where it's at the corporate level. This is where it's divided into 3 sections. So auditing is one of them, and that is when you go through each business transactions that the corporation has done and follow up whether they're doing they're following the accounting guides as well as rules. Okay, making sure that they are doing exactly what they're supposed to be doing. Second is doing taxes. Now, this is one of the largest portions in public accounting that you will often see, is because when we're dealing with taxes at a corporate level, obviously corporates, they don't file taxes until at the end of the year. They don't do it quarterly, they don't do it annually. they do it annually. So if you're a $1 million corporation, you're going to need these professional tax accountants to be able to calculate all the taxes for the whole entire $1 million company, right? They're going to have millions of transactions, so you need to have professional people be able to analyze that. And then lastly, forensics accounting. Okay, so this is for the purpose of forensic accounting is to make sure that you have an investigator to ensure that the company is not doing is not frauding the government, but also making sure that you know that everything that they're recording or auditing is accurate, and that it is and that that is it's accurate, but also that it is true. So the purpose of forensics is if there is some suspicious activity going on, you would be hiring someone to investigate their transactions. So again, that's what forensics is. It's primarily for corporations that kind of do, they kind of want to, not following the guides and rules of accounting. Now, when we're dealing with the private sector, okay, so this is where everything is a little more expansive, but a little more broad as well, right? So we do have smaller tax accountants, okay, but this time we're not dealing at a corporate level. We're dealing for more smaller businesses. So a lot smaller when we're doing with tax accountants, okay? So this could be like a personal tax accountant, for small businesses. We also have an auditing position, which, same thing as a real auditor for the public accounting. But this one is for, internal auditing, making sure that the company is reporting everything correctly. For us, we are primarily going to be focusing on financial accounting. So again, our main job as part of the private sector is to collect, record, analyze, and interpret financial data. Okay, so all we're responsible for is just prepping and preparing the financial statements. Okay. The next section that there is called managerial accounting. Now, this is going to be analyzing the financial data, and this is primarily for the internal users. So if you have a profits manager, or you have someone that's in charge of the costing manager. So anything like that interpreting the financial information for the internal, for the purpose of internal users, it's going to be divided to cost accounting. So again, trying to find the lower cost, and determining how much it's going to cost to produce a product, or how much to cost to produce a service for a particular product, or I'm sorry, how much is it going to cost to provide the service, right? Second thing is going to be budgetary accounting. Again, when you're dealing with managerial, right, you want to make sure that you set a budget. And what that person does is making sure that when you're doing the budgeting accounting, that this is exactly how much money goes in each category or area of the business. Making sure you have enough money for the admin, to pay the admin. Making sure you have enough money to be able to make those costs to purchase inventory. Okay? And then third is green accounting. So again, what green accounting is making sure as a small local business that you are also contributing back to society, back to community by, donating to other companies, right? Being active into the environment, using eco-friendly products, right? Making sure that you have, a good look to your name. So green accounting, right? Then we have two more other ones, which is going to be treasury accounting. So again, this is typical of when you're going into the when you're dealing with the bank, right? So when they need those kind of type of accountings that deal with money on a larger scale. And then lastly, financial planning and analysis accounting. So again, this is primarily for like profit managers if they want to utilize the information just to be able to interpret the information and be able to predict profits. So that's what this one is for. Next one is going to be government accounting. So again, government accounting is going to deal with obviously federal agencies that are funded by the government or that are managed by the federal government. So this is very typical of Social Security or agencies such as One Stop, Job Connect. They're all funded by the government itself. So we definitely need someone to be able to do the accounting for that. Lastly, we have nonprofit accounting. There's actually one more after this. So nonprofit accounting, again, they do have special guidelines because they are not, their intentions is not to make money. Their intentions is just to spread awareness. So they have special rules and special guidelines to be able to have special accounting things for. So again, budgetary. So taking, understanding how the company, what kind of expenditures they need to have. They need to have someone to do budgeting accounting. Lastly is international accounting. What this is many corporations such as McDonald's, something like that. They're a U.S. They're a U.S. business that have many businesses in foreign countries. So they do need to have special guidelines as well as special accounting because it obviously when you're in a foreign country, they do have different rules and guidelines on how their accounting rules apply. So we will look into that in the couple of chapters after this. So again, one that we will be looking for is called the International Accounting Standards Board. So what that is going to be is a whole set of other, basically for the European countries, they do have a set of different guidelines and rules for accounting. So we definitely need someone to do international accounting. So financial reports. There are a total of 4 financial reports that are required to be completed at the end of a given period. So what these financial reports is, each report that you do, it will basically give you some financial analysis on your company. So the first thing that we're going to be looking at is called the income statement. This is also known as profit and loss, P&L. So what the purpose of this statement is to basically determine whether your company made a profit or made a loss. So again, when we're looking into this, we're looking at the total revenues that the company has made, and we're going to subtract all the operating expenses, things that it takes in order to run the business. And then from there, if it's a positive number, it's a profit. If it's a negative number, it becomes a loss. All right, so that's how we utilize this to determine whether our sales exceeds our cost to do business. The next statement that we're going to be looking into is going to be the statement of owner's equity. Because we're dealing with sole proprietors, we're dealing as a small company. Of course, it doesn't have to be specifically owner's equity. If you're a corporation, it's stockholders' equity. But for this particular course, we're going to be learning the statement of owner's equity. Now, what is equity? Equity is going to be the value of the company. Most, when we start off, the value of the company is going to be what you originally invest in the company. And there are some factors that can either increase or decrease the value of the company. So again, when we're looking at your profit margin, at your profits, if you have a profit, if you have an income, if you have a net profit or a net income, what you can do is you can reinvest it into your company. And what that does is it increases your company if it's a profit. If it's a loss, it's going to decrease the value of your company. And there's other factors such as, if you are withdrawing from your company, you're going to decrease the value of your company. If you do capital contributions where you input your own money that did not come from profits, then it will increase the value of your company. Next, we're going to be looking is the next financial statement that we'll be looking into is called the balance sheet. So what the balance sheet does is it follows the accounting equation, which is assets is equal to liabilities plus owner's equity. Okay, so this is going to be a list of all the values of all the assets that you own in the company, and you're going to match it against all the things that you owe to people, and then you're going to also add the value of the company. And the purpose of the balance sheet is making sure that all the stuff that you own is enough to cover all the things that you owe. Okay. Lastly, the last statement that we're going to be looking at is going to be the statement of cash flows. So again, when we're looking into deciding whether your company is going to be cash basis or accrual basis. So again, if you're doing cash basis, this is pretty straightforward. You don't need to convert anything because basically what it is it's going to see how much money, how much actual real cash is coming into the company and how much money that you're actually spending, which is going to be flowing out of the company. So again, with that being said, so if you are on accrual basis, you're going to convert anything that's not cash and convert it into a cash value. So again, what this does is it shows you how much cash is flowing into the company and how much cash is flowing out of the company. All right. Internal controls. Internal controls is basically a form of government or some kind of hierarchy level that allows each individual to split or have certain duties as part of the overall company. Now, again, this is geared towards the Sarbanes-Oxley Act. Okay, so it is basically the separation of duties to ensure the accuracy of accounting and the concepts of accounting. So making sure that these individual people have a separate line of duty to ensure that every accounting is going to be done correctly and following all the rules and guidelines. So with that being said, if you are the sole proprietor and you are the owner of the company, you cannot be the one to touch your books. You need to have a separate person or a separate accountant to be able to do your books for you. Why? It's pretty straightforward. If you're the owner of the company, you can you can manipulate and you can write off random business expenses because you say so and you're the owner of the company. So this is why the Sarbanes-Oxley Act is in play. Now, a little fun fact here. The reason why we have Sarbanes-Oxley Act today is because of Enron. Enron was a major corporation that was dealing with electricity, and what they did is they manipulated its customers because they were a monopoly itself. They were the only company that provided electricity, and what they did is they what's called cook the books. They had Arthur Andersen to come in and write off anything, any bad parts of the accounting book and make it look nice and clean for the external users. So again, Enron is the reason why we have the Sarbanes-Oxley Act today. So that concludes the chapter 1. This includes chapter 1, so the introduction of accounting. So again, this is the course review, so it kind of gives you a little, brief summary of everything that we've learned in this chapter. So again, knowing the definition of the nature of a business, making sure that you know the key points of every single business organization, okay? Then we're going to be looking at, obviously the 3 types of business activities and the 4 financial statements, as well as the 5 areas of accounting, as well as a little brief snip of the difference between a bookkeeper and the accountant, as well as the definition of what accounting is. So thank you, and this concludes the lecture for chapter 1.